Hey, everyone. I'm a U.S. stock fund manager with 15 years on Wall Street. Taking a weekend break, I'll explain why NVIDIA's stock dropped despite beating expectations. If you still don't grasp this, you'll keep paying tuition to the market. Last Wednesday, NVIDIA delivered a report that blew past all forecasts, sending shares up 5% after hours. But within an hour of the next day's opening bell, NVIDIA dragged the entire market down. Tech stocks fell, crypto assets plummeted, and global risk assets tumbled together. It's safe to say no one was spared this time. Many panicked. My LPs and friends all came asking me, "What's going on? Why? Should we cut our losses?" Let me introduce myself. I'm a U.S. equity fund manager at America's largest asset management firm, with 15 years of experience investing in U.S. stocks and having weathered 3 crypto bull bear cycles.
I've witnessed countless market crashes, stampedes, and cascading collapses, but I must admit this one even caught me off guard. In just a few hours, the U.S. stock market lost $1.5 trillion in market value. $5 trillion USD in just a few hours. What does that mean? It's equivalent to Canada's entire annual GDP, half of Apple's market cap plus the entire Tesla market cap, or half of Bitcoin's market cap. This kind of epic plunge has only happened 3 times in the entire history of the U.S. stock market. Once during the early stages of the 2020 pandemic, once this April 25th when the tariff war was declared, and now on Thursday. So I can tell you with absolute certainty, this is absolutely not a routine correction. It's an extremely rare major event in capital markets, impossible to be triggered by any single incident. If anyone has confidently told you in recent days that this crash was caused by December Fed rate cut expectations or Google's Gemini 3 product launch, I can responsibly tell you they're pulling your leg. What force turned NVIDIA's good news into bad news? Is there any hope left for the U.S. stock market? Is there any hope left? Let me state the conclusion first. This isn't a comprehensive bearish signal, nor does it signify a fundamental collapse. The real trigger for this stampede was the simultaneous activation of 3 hidden triggers, mechanisms only seasoned investors understand. Let's break them down one by one. Trigger 1, which many ordinary investors may be completely unaware of, is the sudden surge in Oracle's credit default swap, CDS premiums. What exactly is a credit default swap? Simply put, it's an accident insurance policy for a company's assets. The higher the premium, the greater the market perceives the likelihood of trouble for that company.
For example, imagine you bought accident insurance for your home. One day, the insurer suddenly informs you, "Sorry, your fire insurance premium is tripling." Your first thought would be, "Has there been a major fire in my neighborhood recently? Are there other risks I'm unaware of?" That's exactly the scenario the U.S. stock market witnessed that day. Oracle's CDS suddenly shot up by 111 basis points. CDS for other tech giants like Google and Microsoft also surged dramatically. How did Wall Street interpret this? Simple. The risk associated with tech giants suddenly became more expensive. Even though no one knew exactly what happened, they played it safe by liquidating positions and waiting on the sidelines. Note this crucial point. This wasn't emotional selling by retail investors or individual traders. It was Wall Street's risk management system sounding the alarm after detecting risk parameters across the board. Thus, we witnessed a surreal spectacle. NVIDIA delivered explosive earnings, yet even that couldn't halt Wall Street's models from triggering forced liquidations. This is the first invisible trigger, unknown to non-professional investors but critically important. Trigger 2. The liquidity crisis among crypto market makers. Many still believe this crypto downturn was merely dragged down by U.S. stocks, but if you revisit the data, you'll discover several highly unusual anomalies in the crypto market this time. Market exhibited several highly unusual anomalies. Depth suddenly thinned, large orders could instantly pierce through spikes, and many coin pairs experienced vacuum-like jumps. Additionally, high-frequency trading, typically vibrant in crypto, suddenly vanished en masse. In the crypto world, this signifies only one thing. At least one or two major crypto market makers are operating under severe liquidity strain.
Their identities remain undisclosed for now but may gradually surface. Their actions already reveal that some are struggling to stay afloat. When market makers start contracting liquidity, the entire crypto market enters a mini tightening phase akin to quantitative tightening, QT. What happens to prices then? They don't decline gradually. They plummet so fast you can't even see the bottom. That's why this time you feel like every single coin is crashing, with almost no buffer or rebound in between. At this point, you might ask yourself this question. Over the past years of trading cryptocurrencies, how much of your losses stemmed from misjudging fundamentals, and how much resulted from crises like liquidity crunches or market maker contraction? If you haven't realized this yet, at least you've gained a crucial insight now. Trigger 3 is the VIX volatility spike triggering collective sell-offs. This trigger is the most mechanical yet the most devastating. A VIX volatility surge activates Wall Street's automated sell-off protocols. Let me illustrate with a real-life analogy. Have you ever ridden in an autonomous vehicle? Even if not, you've surely heard that sometimes, when an autonomous driving system misjudges a situation, human drivers can't intervene in time. It's too late. Many large institutional funds in the U.S. operate like these autonomous vehicles. Once volatility, VIX, rises to a preset threshold, the system automatically triggers a red alert. At that point, regardless of price, they sell first and ask questions later. And it's not that they want to sell, they have to. Back to Thursday afternoon. The VIX surged rapidly to 27 in a short time, triggering VolTarget's automatic sell orders. CTAs began systematically reducing positions, and risk assessment models automatically narrowed risk windows.
In plain language, the more they sell, the higher volatility rises. The higher volatility rises, the more sell orders it triggers, creating a classic vicious cycle. That's why witness such an extreme spectacle. NVIDIA, an S&P 500 heavyweight with an 8% weighting, could plummet from a 5% gain to a 3% loss within hours. This was absolutely not the work of a single institution, but the collective action of Wall Street's trading systems. There are two other points Wall Street has been closely monitoring, yet I've noticed almost no one mentioning them, and they were crucial accelerators in this crash. One is the imminent release of the Epstein Files Act. President Trump recently signed the Epstein Files Transparency Act, requiring the U.S. Department of Justice to disclose all classified materials within 30 days. Markets are deeply concerned that if the list implicates Wall Street titans or executives from major U.S.-listed companies, it could trigger a cascade of reputational risks and political earthquakes. When corporate leaders face trouble, it's usually significant. Such risks may not immediately impact a company's stock price, but they are sufficient to prompt capital to reduce positions and adopt a wait-and-see approach. On the same morning, Trump also posted several extreme tweets, one of which directly stated that mentioning that treason should be punishable by death. This inflammatory rhetoric prompted immediate, strong condemnation from Democratic leaders and multiple lawmakers, who issued a joint statement denouncing Trump's political violence. The market's interpretation was straightforward. Escalating political extremism would heighten political instability and policy uncertainty. The most telling detail was the timing. Trump tweeted at 10:21 a.m., and just minutes later, U.S. stocks began a cliff-like mechanical sell-off. Unfortunately, you can look back and see that while it wasn't solely caused by this one tweet, it certainly became the final straw that broke the camel's back for U.S. stocks. By now, you should have realized that this crash wasn't triggered by any single piece of bad news, but rather by multiple triggers within the market structure: thinning liquidity, automated sell orders, and the political accelerator. All these factors combined to create a stampede and epic plunge. The real question you should be asking yourself is, what should I do next? In fact, I repeatedly warned last month that November would bring extreme volatility to U.S. stocks. I shared the specific reasons daily in the members group. The coming week may be even more illustrative as Thanksgiving approaches. The market closes on Thursday, and Friday only trades until 1 p.m. That means only 3 truly effective trading days remain. Every year, around this time, several patterns typically emerge. First, volume in the U.S. market will drop significantly. Second, liquidity will thin out. Third, the market will become more susceptible to manipulation by smaller capital. Consequently, false breakouts and false breakdowns at technical levels will increase markedly. This means the probability of massive volatility could rise substantially. So, what can you do next? I'll provide a framework for thinking, not investment advice. First, in the short term, watch whether NVIDIA can stabilize. NVIDIA is the most critical variable in the U.S. market, as the bellwether of this AI trend and holds substantial weight in the market. Its price dynamics will heavily influence market sentiment. Second, the broader U.S. market remains in a corrective phase rather than a full-fledged rebound. Any rallies or pullbacks in the coming days may be amplified by holiday liquidity constraints. A clearer directional bias may emerge only after Thanksgiving when liquidity returns. Overall, the foundational support remains intact, though short-term positions will undoubtedly feel uncomfortable. Yet, from a longer-term perspective, this downturn resembles a violent repricing and forced deleveraging rather than a global apocalypse. Finally, a question for you. Did you set stop losses ahead of this crash? Did you preserve cash reserves to gradually build positions amid panic? I hold a portfolio of key U.S. sectors and stocks, patiently awaiting more reasonable risk-reward levels before decisively buying. So, this time around, what assets do you most want to chase the bottom on? Which ones do you have the most confidence will rebound? Feel free to share your thoughts in the comments section. Click the subscribe button and stay tuned to my channel. Translated with DeepL.com, free version.